In today's episode, I'll talk about three very interesting stories. In the first story, I'll talk about Swiggy's upcoming IPO and what it really means for us as investors and the market at a broad level. In the second story, I'll talk about India's semiconductor dreams and how Tata is fulfilling them. And in the third one, I'll talk about how our groceries might get a little more expensive going forward. Welcome to the Daily Brief Show by Zerodha, where our goal is to give you information and news in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 30th of September. By the way, a very quick announcement before we begin today's episode. We've recently started a new Saturday special series called the Global Brief. The idea here is to cover global stories regarding economics and finance to give you a sense of what is exactly happening across the world. I hope you enjoy. Let's start by talking about Swiggy's upcoming IPO. See, Swiggy, the very popular food delivery giant, is getting ready for one of the most anticipated IPOs in the Indian startup story. Now, if you've been following the Indian markets, you'll probably know that this is a really big deal, especially after the IPOs of Zomato and Paytm. Now, Swiggy is aiming to raise 3,750 crore rupees through a fresh issue of shares with an offer for sale or OFS from investors like Prosus and Axel, pushing the total IPO size to over 10,000 crore rupees. But the big question here is, where does Swiggy stand against its biggest rival Zomato, and what makes it stand out, if at all? Let me break this down in today's story. See, Swiggy plans to use these IPO funds for a few key initiatives. First up, 982 crore rupees is set aside for expanding Instamart, which is its quick commerce arm which promises grocery deliveries in under 30 minutes. That is a big investment into dark stores, which by the way are basically mini warehouses for faster deliveries. On top of that, Swiggy plans to invest another 930 crores towards marketing and brand promotion. The message from Swiggy is probably very clear for us. They are laser focused on grabbing more and more market share, especially in quick commerce, which has become a fierce battleground if you think about it. Now, interestingly, Swiggy was actually the first major player to actually dive into quick commerce in India with its product Instamart. The early mover advantage should have been a big win in a way, but Zomato then very quickly came into the scenario by acquiring Blinkit, and that completely changed the rules of the game. Today, Blinkit holds about 40% of the quick commerce market, while Instamart is right behind at 32%. Then there's also Zepto and a few other quick commerce players that are also threatening to capture market share. But what is interesting here is that while Instamart has been very critical in boosting Swiggy's presence, it is only their third largest revenue stream. Compare that to Zomato, where quick commerce is their second largest revenue driver thanks to Blinkit's massive surge. Now, when you look at the broader picture, both Swiggy and Zomato have diversified business models, but their revenue streams look very different from each other. Let me explain food delivery first. See, this is still the bread and butter for both these companies. In quarter 1 of FY25, Swiggy's gross order value or GOV for food delivery hit 10,189 crores and it grew 23%. But Zomato outpaced them here and they grew 53% to reach 15,455 crores. Zomato is definitely leading here, and with 18 million monthly active users as compared to Swiggy's 12 million, it also has a strong edge in user engagement in a manner of speaking. And then of course, there is the red hot baby of today, which is quick commerce. And that is where things get really competitive. See, Instamart posted revenues of 403 crore rupees, which is a solid 90% jump. But Blinkit more than doubled that here with 942 crore rupees in revenue and grew about 145%. The take rates, which is basically the commissions, tell a very similar story as well. Blinkit's take rate is 19.1%, while Instamart is just at 14.8% right below it. So despite Swiggy's early mover advantage, Zomato has almost leapfrogged them in this space. Then of course, there is the B2B supply chain. See, Swiggy's B2B segment includes warehousing and logistics services, and it brought in about 1,268 crore rupees in the first quarter of FY25, and it made it their second largest revenue source. But on the other hand, Zomato's Hyperpure, which plays a very similar role, is growing but still very small in comparison. But that said, there is a very important area where Zomato largely outpaces Swiggy, and that is profitability. See, in quarter 1 of FY25, Zomato posted a net profit of 253 crores. But Swiggy, on the other hand, is still in the red with losses of 611 crores during the same time period. Now, a closer look will reveal that Blinkit's losses are also smaller than Instamart's, which gives Zomato a slight edge in terms of efficiency when it comes to quick commerce. Now, Swiggy and Zomato both dominate India's food delivery market together, but Zomato is currently leading in both food delivery as well as quick commerce, which gives them a very big advantage here. Also, Blinkit's super aggressive growth and higher operational efficiency have helped it pull ahead of Instamart very quickly. Now, over here, it is very important to note that while Swiggy has 557 dark stores for Instamart, Zomato is aiming for more than 1,000 dark stores for Blinkit by the end of this financial year. Now, this fight for market share is very much still on, and it is likely to intensify even further when you look at tier 2 and tier 3 towns, where the next wave of India growth is expected to come from. So now the question is, what is really next for Swiggy after their IPO? See, the company has a very strong growth story to tell. With a diversified revenue model, a first mover advantage in quick commerce, and a very solid user base, Swiggy has plenty going for it in its favor. But on the other hand, Zomato's dominance in both food delivery as well as quick commerce means that Swiggy has a lot of work cut out for itself. The next few years will be very critical. Both companies will continue to battle it out, especially in quick commerce, where growth in India's smaller cities could really change the scales. Now, how Swiggy exactly navigates all these challenges will really determine whether their IPO lives up to the hype or not eventually. Moving on to the second story, I'll talk about Tata's big bet on semiconductors and why it could be a major development for India's future technology plans. See, currently India's chip making industry is very underdeveloped. Even though we as a country have made some really good progress in assembling, testing, as well as packaging chips, we have not quite cracked the actual manufacturing part of it. But Tata is now looking to change all of that, and they are taking some very serious steps to do this. But before I get into all of it, in case you guys are wondering what the hell a semiconductor chip is and why is everyone suddenly talking about it, let me give you a very quick 10-second explainer. See, think of semiconductor chips as the brains behind all your electronic devices. They process information, store data, and control how all our devices function. Whether it is your smartphone, computer, your car, or even your washing machine at home, semiconductor chips are what make these devices smart and capable of performing very complex tasks. Now back to Tata, they've recently partnered with PSMC, which is one of the world's largest chip makers, to build India's first semiconductor fabrication plant in Dohera, Gujarat. By the way, make sure you do not get confused between PSMC and TSMC. Both of these are Taiwanese chip manufacturers. TSMC is the world's largest, while PSMC stands 7th. The company that Tata is partnering with is PSMC. But back to the story now, this partnership is massive because PSMC will help with everything from the design to transferring key technologies to India. And this fabricator will produce up to 50,000 wafers per month, which for your context are thin slices of semiconductor material which eventually turn into chips that power our devices. Now, Tata is investing a massive 91,000 crore rupees into this project. But it is not just about one factory alone. Tata is laying the groundwork for an entire ecosystem around semiconductor manufacturing in the country. This could create up to 20,000 skilled jobs initially and eventually up to 1 lakh skilled jobs, which is brilliant for the economy. But the thing is, why does it matter to us? Look, like I said, semiconductors power nearly every piece of tech that we use right now, and India relies heavily on imports for it. Tata's fab will produce logic chips, which are critical for technologies like AI and high-performance computing. And given that there is a global chip shortage today, Tata's move here could potentially make India a key supplier in the global semiconductor market over time. But that said, things are not at all going to be easy. Companies like TSMC and Samsung have spent decades altogether to perfect their processes, and even today they face multiple challenges. So Tata's partnership with PSMC is very crucial to get this project off ground in India. Now, as part of his future plans, Tata also plans to build multiple fabs in Dohela, which could create over 1 lakh jobs in the country. But the thing is, India has always struggled with shortage of skilled workers, especially in high-tech sectors. But the good thing is that Tata is recognizing this problem and is looking to invest in workforce development as part of this semiconductor project. As part of all of it, Indian engineers will receive hands-on training at PSMC's Taiwan facilities to ensure that they have the right skills that are required to operate these highly complex fabs. So all in all, in summary, Tata's semiconductor push could be a major step towards India becoming a very important player in global chip supply chain. As the demand for chips continues to grow every day, this could position India as a crucial alternative supplier in the future. Let's move on to the third story of the day. This is a relatively shorter one. See, Motilal Oswal recently released a new report on commodity prices, which talks about some very important trends to watch out for as an investor or a consumer. Let me give you a very quick summary of some interesting trends that you might want to keep a tab on. First, agricultural commodities are on the rise. Wheat prices are up 11% year on year, and barley prices have jumped by 15%. Now, this could mean some trouble for companies like United Breweries and Nestle, which heavily rely on these raw materials. Coffee is also seeing a big spike. It is up 14%, which might push costs higher for brands like Nestle and Hindustan Unilever. But the question is, what does this mean for you and me? Look, it's likely that these rising costs will eventually be passed on to us as consumers. In other words, we could be very soon looking at much higher grocery bills than we are paying today. There's also the edible oils market that the Motilal Oswal report speaks about. Import duties on crude palm, soybean, and sunflower oils have surged from 0% to 20%, and refined oil duties now stand at 32.5%. Now, this move is meant to help domestic producers, but it also puts a lot of pressure on FMCG companies like Britannia, Dabur, and Marico, which heavily rely on these oils. Now, as a result of all of this, we might start to see price hikes on everyday items like biscuits and cooking oils. But like everything, it's not all bad news here. Non-agricultural commodities, particularly crude oil, are now starting to cool off. Prices are down 7% year on year, largely thanks to China's economic slowdown. Now, this could be a little bit of a relief for companies like Asian Paints and Pidilite, who might enjoy better margins with lower raw material costs. But that said, inflation is putting some serious pressure on FMCG companies. Key inputs like wheat, sugar, and milk have all increased by 4% year on year. So giants like HUL or Hindustan Unilever and Britannia are likely going to feel the squeeze quite a lot. So in order to protect margins, we increasingly might see more price hikes on household goods in the months ahead. So while there is some relief on certain sectors, inflation is still very much a challenge for the others, especially in food and FMCG as a space. Now moving on to the last section of the day, which is the small tidbits. First, Chris Capital is set to acquire Theobroma Foods and Belgian Waffle Company for a combined valuation of 3,200 to 3,500 crores. This move is aimed to build a consumer brand investment platform and tapping into India's growing food services market, which is projected to hit 7.76 lakh crores as early as FY28. Second, Apparel Retail, which is Amazon's former top seller, has petitioned the Karnataka High Court to stop the CCI's antitrust investigation, which alleges that Amazon and Flipkart favored selected sellers, potentially setting a precedent for others to challenge regulatory actions. Third, OpenAI is restructuring into a benefit corporation to attract investments and potentially reach a $100 billion valuation. Now, this change follows key leadership departures and it aims to balance AI development with managing ethical risks. Next, India announced a modest wage hike for informal sector workers starting from October 1st. This is in response to rising living costs with adjustments tied to inflation based on CPI trends. Fifth and the final one, Accenture reported a Q4 2024 revenue of 16.41 billion US dollars. This was heavily driven by an increased demand for generative AI solutions. Accenture also announced a 4 billion US dollar share buyback, which signals strong investor confidence. That's all the news and stories I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care. Goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.